welcome to the Contraturtle show, where Singaporeans build towards financial freedom through long-term investing. I'm appearing as a pig again because Google doesn't support turtles, and my guest is Serjing. He's a friend, and he's actually the true mentor behind many of my investment ideas. So this part is a bit paiseh and cringe for my guest, but I have to do it because the viewers might be wondering, why should any of us listen to this Singaporean guy, Serjing? What's the big deal, right? So I actually did some research on him. So let me just toot his horn a bit lah. Between 2010 and 2020, for 10 years, Serjing actually achieved a 19% CAGR performance for his stock portfolio, and it beat the S&P 500, which only did 12% CAGR in the same time period. And then in 2016, he actually warned about problems at HiFlux, and that was a good 2 full years before the company actually suspended trading in 2018. And most impressive of all, he actually bought Netflix at $13 at around the end of 2010, and he sold it in 2020 at a price of about $500, which means he made about 40x-ish in return from the stock. But the truth is that he wouldn't have sold the stock at all if not because he wanted to start a fund, which now also has Netflix once again, but maybe I'll let him explain about it later. So he also inspired me to look into Mercado Libre, which has almost doubled by now. Very thankful for that. Meta, which has already doubled, and Netflix, which is my best performer to date, which has tripled in value for me. So these are actual screenshots from my broker and all that. If you actually look at this, I actually went to calculate in total. I've actually made $175,000 from these positions. These are tangible stuff that I made from sort of the things that he advised me on. So actually, I owe him copy lah. So I made a lot of money from some of his ideas lah. Okay, so anyway, I hope that was not too cringe. So today I'm going to uncover Serjing's investing background and his methods. And I want to emphasize, really important, that whatever we are sharing today, none of this is financial advice. Please remember to do your own research. So without further ado, I'll let Serjing, maybe you can do a quick introduction about yourself.
Sure, thanks Contraturtle. And just before I start, also a disclaimer on my part, nothing I say here today should be taken as investment advice. And I may hold positions in some of the stocks that we talk about today, if we're going to be talking about the stocks. So I'm Serjing. I entered the finance or investment industry back in 2012 or 2013. With the Motley Fool Singapore. So the Motley Fool is this American company that is well known for giving investment advice through their newsletters in the US. And so they set up a Singapore office in 2013. So I was one of the very first few employees to join them in their Singapore office. So I was with them all the way to the Singapore office closed down in late 2019. And then I set up a investment blog together with my friend, Jeremy Chia. And we also set up an investment fund in 2020. So now we have an investment blog called The Good Investors.sg and an investment fund that we run together that invests in stocks around the world.
Cool. So that's thanks for sharing that, Serjing. So I kind of want to start from the beginning. I've actually known Serjing from quite young actually. We weren't that close before. We went to the same school, but you took a very unconventional path after your studies, right?
Kind of, if you can say so.
Yeah, because most people, they went for internships and stuff, and then they went to the typical office 9 to 6 kind of corporate job. So maybe can you tell us about how did that happen? What inspired you to do that, and how did that go about?
So I think it can be traced all the way back to my junior college days. So I was doing economics as one of my subjects. And so the teachers were teaching us about money and how it works. And I realized that some of the underlying assumptions that were being taught did not make sense to me. And I remember one of the assumptions was that, if people have spare money, they would take that and invest in bonds or fixed income. And I remember looking around at all the adults that I knew, and none of them were doing it. If they have spare money, they would be using it for all kinds of different purposes other than investing in bonds. So I decided to look for people who worked with money to kind of really understand how they think about money and what it means. So I eventually discovered Warren Buffett and his circle of investor friends and mentors. And I came to learn about people like Benjamin Graham, Philip Fisher, and so on. So I made a note to myself that I wanted to buy this book written by Ben Graham called The Intelligent Investor. But at the point in time, when I was at the bookstore, there were no smartphones. So I had no way to look up information. And I actually forgot the name of both Ben Graham and the book. So I was walking around the shelves and I saw this book that says, that had Buffett's recommendation on it. And I thought this must be the right book because Buffett has not written a book. So, and if there was a recommendation, it was likely the correct book. And so I bought it and I went back home and I realized, oh no, it's actually the wrong book and the wrong author. So the book that I ended up picking up was Philip Fisher's Common Stocks and Uncommon Profits. But then I realized that, hey, Buffett had this other mentor that was less well known, but that was, I guess, equally impressive. So I started reading the book. It was a difficult book to read as the very first introduction to the financial markets. For a young student back then, I was 17 or 18. But a lot of what was mentioned in the book made a lot of sense to me, and so the lesson stuck with me. And I think one of the biggest foundational things that I took away from the book was that the stock market has a certain pattern to it, and the pattern is that stocks are actually pieces of businesses, and these stock prices will eventually, in the long run, reflect the underlying performance of the business. So that was the most foundational thing that I took away from the book, and it just made a lot of sense to me. So I started developing an interest in investing and finance after reading the book, and so started buying all kinds of different books about the stock market, and tried to educate myself. And so that went on all the way to I was going to enter university. So when I was choosing my what to study in university, I was thinking about two paths. So I could either enter the world of I could do like a business or investing or finance related course, or I could do something related to the sciences or engineering, because I also have a interest in like the math, the sciences. But I realized that it was a lot easier for me to learn about investing on my own as compared to learning about the sciences and engineering on my own. And through reading all the books about Buffett and his circle of investor friends, I had this idea that a lot of what was taught about finance in university was perhaps not very applicable to real life situations. So I made a decision eventually to do engineering in university. So I went to National University of Singapore and took up engineering science. So my interest in investing kind of died down a little in my first year or two in university. But there was once when I was still in school in university, and I was at summer internship, and I had some spare time in the office, and I decided for some reason to look up investing topics again. And so I started reading, and I came across articles by the Motley Fool, and I got hooked because the writers there they were writing about investing in a very interesting way, and that kind of really rekindled my interest in investing. And so I decided that I wanted to make investing a career. And at that point in time, I was also kind of a little optimistic youth. I had a lot of youthful optimism, and I thought that okay, there were only a very small handful of companies that I really wanted to work for, and one of them was the Motley Fool, because they really cared about their customers, and they had this idea of investing that really resonated with me. And it just so happened that in 2012, which was when I was in my final year in university, the Motley Fool set up this thing called the blogging network, where they wanted to look for writers outside of finance to start writing about investing related topics. And the idea was that if they liked what you were doing, they would publish your articles under your name and give you a small payment for each article that you publish. So I decided to give it a try. And so I wrote a few articles for them. The team that was running it liked what I was doing. And so I think it was in middle of 2012 where they decided to organize a one-day conference in their offices, which was based in Virginia in the US. They decided to hold this one-day conference for some of the better writers that they found through the blogger network. They invited me without realizing that I was not from the US. So when they set up the blogger network, they did not expect to attract anybody from outside the US. But it just so happened that there were quite a number of the writers that were invited who were not from the US, as it turns out. So I was one of them, and when I appeared in Virginia, they were really excited to realize that I was from Singapore, because it was at that exact point in time where they were trying to bring the Motley Fool into Singapore. So I attended the conference. I came back to Singapore. and was put in touch with the team that was trying to bring the Motley Fool into Singapore. That was in, I think, the third quarter of 2012. And then so I was in touch with the team, and in close to Christmas 2012, I got a call saying that hey, we're going to be launching the Singapore office officially in January 2013. Why don't you come on board? We would love to have you. And so I jumped on the chance. It was more or less like a dream come true for me. The stars were perfectly aligned. I even to now I think I think I'm really lucky to have had that opportunity. So I joined the Motley Fool Singapore in January 2013, and was helping them write articles about the Singapore stock market and stock markets around in other parts of the world. And in 2016, May 2016, we launched our first investment newsletter where we pick stocks from Singapore and around the world and recommended it to our subscribers. So I was helping to run that till the Singapore office closed down in late 2019.
Thanks for sharing. I think I really envy the story because there's two things about it that I really like. One is that I feel like you found the passion so early in your life. And there's probably only just that 1 or 2 years where you chilled out a bit from investing, right? When you were in university, that you didn't really take investing seriously. But then again, you went back again after you found those articles and resources, right? And then you went straight into Motley Fool. Like, I feel like for most Singaporeans, even myself, we wouldn't have dared to, how do I say it, just pursue what you really love to do. Like, even for myself, I went into a corporate job in the office 9 to 6, even though I may have my dreams, but I didn't dare to actually go and do it. So I think that's really commendable lah, especially in our this kind of environment here in Asia and Singapore, more conservative.
Yeah, no, I was gonna say I think I have my parents to thank for. I did not come. I'm not from a wealthy family, but we were comfortable, and I knew that my parents did not have to depend on me to put food on the table. So I had some space to be able to do some crazier things.
I know some of my friends, they even fell out with their parents just because they want to take like unconventional routes, right? I got some friends wanted to do business or wanted to do things not in the office job, then end up they just fell out with the parents lah. So it was not. So yeah, exactly. You're absolutely right. The family and the people around you really do make a difference. So I think it's quite funny because the book that you accidentally thought was Buffett was Philip Fisher, right? The first book.
Yes, that's right. That's the very first book that I that introduced me to the stock market.
Okay, so that book, in my opinion, for me, is my favorite book. So it's quite funny that you got it accidentally, even though you didn't really want to. But I'm sure it has some good impact for you lah, like you said.
It did.
Yeah, so like for me, right, some of my viewers know that I do a lot of scuttlebutt. I think you also know. I love to look at anecdotal stuff. I love to talk to employees. I go to Lululemon. I go to the EV showrooms and I talk to the drivers. I talk to the salespeople and I talk to customers. And actually, I got this idea from Philip Fisher. And the whole idea of growth stocks and the long-range, long-termism actually also started from Philip Fisher. So I think it's amazing that that's your first accidental book lah. It's not that bad.
Yeah, I think I have been lucky.
And also like Motley Fool, just for the viewers, Serjing also recommended me a book. What was the book again? I've really forgot the title. The Motley one, the Motley something.
Rule Breakers and Rule Makers, or Rule Makers and Rule Breakers. I can't remember the order.
Yes, exactly. So I actually read that and it's somewhat aligned with Philip Fisher in terms of the growth aspects of things and the qualitative things. So
that's right.
Yeah, those two books really came together for me, and yeah, I mean, I just want to thank you for recommending me. Cool. And okay, we're gonna start to get into some meaty stuff. So we're gonna, because I know by now the audience are all very they want to know stuff already. So tell me, Serjing, what is your investment framework in picking stocks, your style, your philosophy? Go for it.
So I think the very foundation of what I do is I look at stocks as a piece of a business, and with that idea comes the next logical step that a stock's price would eventually end up where its business would. So the idea that if that is the case, then I should be looking for businesses that will become much larger over a long period of time. And how do I go about looking for such businesses? So we have this framework for. So we call such businesses compounders and we have a framework for looking for such businesses. So there are 6 things that we tend to look out for in all our investments. Right. So the first is in no particular order. Right. One is that this is a company that must be operating in either a large market that is growing, or if it's a small market, it must be growing rapidly. Right. So the idea is that we want a company that has a lot of room, natural room to be able to grow. So that's the first thing. The second thing is
I'll just for the audience, do you have an example of this first criteria you just said, like example industries that illustrate this point?
Yeah, sure. So I think a really interesting one will be Intuitive Surgical, American company that makes the Da Vinci surgical robots. There are some hospitals in Singapore that actually have those robots. If you have seen any of them, and I think it's a great example of a company that is operating in a market that is relatively small, but that is growing fast. So, like the company is actually one of the largest in its space. So it holds I don't have the numbers off the top of my head, but it holds the lion's share of the particular robotic surgery market globally. But that market is growing fast, right? Growing double digits year on year. And so I think that's a really good example. And I think it's quite, if you think about what surgical robots, the benefits that surgical robots bring, they help patients recover faster. The wounds are smaller, and they probably also help healthcare systems deliver a lower total cost of care. So there are, I would say, great benefits that robotic surgical systems bring to society. So I think it's only natural. I don't think, I think there are very few things that are certain in life, and I don't think that it's 100% guarantee that surgical robots will continue taking market share away from surgical procedures that are done by hand. But I think the chances are high that surgical robots would continue taking up market share because of the benefits that they bring.
Yeah, so I wanna ask you because we're gonna sidetrack a little bit, and then we're gonna go back to your 6-step framework, because right now we're still on step number 1, fast growing revenues. I have 2 questions for you based on what you did so far. When you say fast growing, right, are we referring to revenues, or do you look at earnings, or like what do you look at?
If it's just the market alone, it would have to be the revenue, right? So there's another part of my criteria where I actually look at the other parts of the financials of the business, which includes its earnings and its cash flows. But if I were to be talking about the market, then it would really have to be the revenues that are generated by the participants in the market.
Okay, so ISRG, and some of the audience also know I'm also starting to look at that. Again, I must say I'm not financial advisor, guys. We're just having discussion here. So ISRG, so you're talking about it's a dominant player. Sorry, what's the criteria again? Dominant player in a fast-growing market, was it?
It's either a dominant player in a fast-growing market, or it's a kind of a smaller player in a large or growing market.
So ISRG falls into the first one.
The first one, yes, that's
first
right.
one, right? Dominant player in a
fast-growing market.
In a fast-growing market. Okay, got it. How about the other example? A small player in a big market.
Well, small player in a big market.
Yeah, like a fast-growing market.
I think your personal largest position, Meta, would be a good example. I mean, as big as Meta Platforms is, if you look at its revenues in relation to the total global advertising market, it's still a small minority of the total global advertising market. And even within the digital advertising market, of which Meta and Alphabet are like the kingpins, Meta is still smaller than Alphabet. Right, so I think it's a good example of a business that is still somewhat small in a large market.
Actually, in my mind, I think of Meta as a monopoly in its own social network.
You can define it as a monopoly in the social network space. But I think Meta, given its current fight with the US government, will not want to define it that way. But if you look at but from my perspective, if I were to think about the revenue markets that Meta is trying to attack, I would say that it's still small in a large market.
Got it. Cool. I'll let you carry on with the first part, and then you can carry on with the rest of your 6-step framework kind of things. You
Yeah,
can go
sure.
for it.
So the first one is in terms of the revenues and the market. So the second one would be a strong balance sheet with minimal or reasonable levels of debt. And this is important for us because we invest on the idea that bad things will happen from time to time. It's hard to predict what these bad things are, but the idea is that when a company has cash, it's cash rich, has little debt, it's able to withstand any of the withstand these bad things that can happen. So we like a strong balance sheet. And then the third thing we look out for is we want management teams with integrity, capability, and the ability to innovate. So this is where we spend a lot of our time on, just trying to study the management team. The integrity part is important because if you can have, even if you have a really capable management team, but if they do not have integrity, meaning that they are not looking out for the interests of minority shareholders, the company may flourish, the management team may flourish, but you as a minority shareholder may not. I think that integrity part is also really important. And what we like to do when studying this aspect is to just really look at the history of the company and how they have grown over time, and what the management team has done to grow the business. Have they been able to think in very unique ways about their markets or their products or services? And have they been able to? And I think the most one of the best things that we like to see is a company that has been able to expand into completely new areas. So there's this term from David Gardner, who's one of the co-founders of the Motley Fool, called optionality, and it's this idea that some businesses have tremendous optionality where they are able to grow into completely new markets, like 5 years from now, 10 years from now, compared to what they are working on today. So that's the third thing. Then the fourth thing is we like revenue streams that are recurring. So this can be because of contracts, so like a subscription service, or it can be because of customer behavior. So I think one of the examples that we really like to use is MasterCard and Visa. So each time when you make a payment with MasterCard or Visa, these companies get a small cut of the payments that you make. And because you make these payments often, it's even though there's nothing that binds you contractually to use them, but because that kind of payment behavior is so ingrained, the revenues become more or less recurring in nature from our point of view. Then the fifth thing is a proven ability to grow. So this is where we also look at the other parts of the financials of the business. So just revenue growth. So what we look out for is we look out for things like revenue growth, profit growth, and free cash flow growth. Of course, if you are looking at financials or companies in the financial services industry, then we'll be looking at other metrics for determining the growth. But by and large, for most businesses, we are looking out for growth in revenue, profits, and cash flow over time. So we want companies that have this history of being able to produce good rates of growth in this matrix. And then the last thing we look out for is we want companies that we think have a high probability of being able to generate strong and growing stream of free cash flow in the future. Because ultimately, the value of a company is the amount of cash that it can generate from today to the day it ceases to exist, and you discount that cash back to the present. So the more cash, the stronger the cash flow that a company has, the more valuable it is. So ultimately, what we want is to see see a company that has the ability to generate strong free cash flow in the future.
Is there a sort of priority, or if you could put your finger, like the most important of your criteria, and also have you made exceptions before?
So in terms of priority, no, I would say all are equally important because I think they all come together. I don't think it's possible to kind of have like just one single thing and not care about the rest, because I see this, because the way we look at it is that all these are like somewhat interlocking aspects of a company. For example, if you have a management team that is not capable, then it's very unlikely that they will have that the company has an ability to generate strong free cash flow in the future. Right? The company might be able to do it, but it's going to be because of luck rather than management skill. Right? So I think all of these things play together and come together. So I don't think there's any one that is more or less important. Can you remind me of your second question again?
Oh, I was gonna ask if you have ever made exceptions before.
Exceptions, yeah. So, yes, like an example, in one of the criteria, we say we like to look for companies with a proven ability to grow, and we like to look for growth in revenue, profit, and free cash flow. But we have invested in companies that, for certain periods of time, have been unable to generate free cash flow. So I think Netflix is a good example, because earlier, right now, I mean, Netflix is really starting to kind of be able to generate strong free cash flow. But if you go back 5 years or 10 years ago, it wasn't it wasn't that clear necessarily that it was able to generate strong free cash flow. And the reason was because it had to spend a lot of capital upfront to build its content library. But the way we thought about it was that this content library is something that can be monetized for a long period of time. And so in some ways, it's kind of paying upfront for inventory that can then be monetized over a long period of time. So we were comfortable from that aspect. But I would say that if there is one thing that we will not compromise on, it's likely going to be management integrity. But again, never say never. There may come a point in time where we chance upon investment situations where it's so compelling despite a horrible management team. But I would say, by and large, the integrity portion is like really important.
Got it. I mean, this is a chart on Netflix. How is it possible that you discovered Netflix at $13? Like, what was going through your mind at that point so early on in this company? And
Oh, by the way, I need to clarify. So I think I bought it at 16, not 13. But
16. Okay. I mean, it's just $3 now. It's like, okay.
So I invested in Netflix in 2011, and that was shortly after its Quickster debacle. So I'm not sure how many people who's going to be watching this would remember, but back then Netflix was primarily a DVD by mail business. So it had a website where you could go to choose DVDs for rental, and it would then send you the physical DVDs. And so streaming was something that was introduced only a few years prior to my investment, and at that point in time wasn't even the main source of revenue for the company. But management's rationale back then was that streaming was the way of the future, and so they wanted to spin off the DVD by mail business, and it was to be named Quickster, and keep Netflix as the name for the streaming service, and they wanted to go all in on streaming. So I thought that was a really interesting move by management. So are you familiar with this concept called this concept of disruption that was coined by Clayton Christensen?
Is that the innovator's dilemma guy?
That's right.
So I guess Google is an example now, right? Of people debating over that, right? Search versus GPT.
That's right. So the idea about the innovator's dilemma or disruption is that his idea is that oftentimes the incumbents get disrupted by upstarts because the incumbents are unwilling to kill their existing cash cows. But when I saw Netflix willing to spin off its cash cow, which is the DVD by mail business, to go all in on streaming, which at that point in time was still a really new concept. I thought that this was a company with a management team. This is a company that is very unlikely to be disrupted because it was so willing to kill its cash cows. Like nothing is sacred for the company. The management team always has its eye on the future. So I thought that was a really interesting angle. And that was actually one of the key things that made me want to invest. And of course, it was also the fact that when I first invested in the company, I actually first invested at 25, and then it went on to fall to 16. And I think from top to bottom, when I invested, I think there was like a 70 or 80% decline in its share price, and I actually kind of suffered through most of it. I think at the bottom, the share price dropped to like $7. From my $25 initial purchase price, I was sitting on easily at like a 70% loss or something like that. But it actually, so when I bought it first at 25, it had actually fallen by quite a decent amount from its high, and I thought that that didn't really make sense because the company was still reporting very strong subscriber numbers. If my timeline matches, I think what happened was the company reported a very small decline in subscriber count. So that was the first time in many years where it had a small decline in subscriber count, and the market freaked out, which caused its share price to crater. And so that was the point in time at which I invested. So there was that decline in the share price based upon a very very small drop in subscriber numbers, and the idea that this is a management team that is really that is undisruptable and that has its eyes firmly on the future. And so that made me really interested to invest in the company.
You know what's funny? It's a bit of deja vu, right? Because just a few years ago, Netflix reported just a small amount of drop again, right? You remember that?
Yes, that's right.
And we saw it again, history repeating itself. So, I think some of the viewers, right, they struggle with this emotional control, fear, especially when they think that they want to invest for the long term. But when things like what you just described happen, falling to $7, when you bought in at 16, when you bought in at $25, like, can you sort of tell us what was going through your head, number one, and number two, like, was this emotional control and not fearing the fall something that was developed and you trained or learned from somewhere, or was this natural?
So what I did was I just kept my focus on the fundamentals of the business. So remember I mentioned that the company had lost only a very small number of subscribers, right? And the next quarter, growth in subscribers resumed. The fundamentals of the business still looked really healthy to me. And so the decline in the share price just did not make any sense to me. And so, like, remember I said earlier that one of the core things that I took away from Philip Fisher's book is this idea that a stock represents a piece of a business. So from my perspective, the underlying reality of Netflix was good and healthy and strong. The share price was another story, but because the underlying reality was so strong, I had no issues. In terms of holding on through that big decline and eventual recovery.
Got it. And so you mean really it's from like Philip Fisher's book, and then it just came to you that, it's just the price, what, I only care about the underlying piece of business. It really developed from there, that kind of mindset.
Yes.
Okay, because then you are exceptional, because most people take very long. And even for me, to be very frank, I think a lot of viewers don't know something about me. I have a lot of viewers asking me, hey Turtle, how come you are able to have a good night's sleep when the Trump tariff war happened, and my portfolio lost 105k in the span of 2 weeks, and I slept like a baby actually. And a lot of people actually don't know, because I have a background that I play poker before. So at the beginning, I was very scared of money losing, and for me, it was through emotional training. So I think that you are natural lah. You have talent in this aspect. We cannot downplay that part. It's not so easy. Okay, really interesting. I'm going to show you this thing here. I actually saw this random picture. If you were to sort of combine all the philosophies you talked about just now, do you see yourself on this spectrum somewhere? Like where will you put yourself?
This is really interesting. First time I'm seeing this, but I think where would I put myself? Probably somewhere in the middle.
Would you put yourself to the left or right of someone? Like how you, maybe use some of the legends?
Yeah, sure. So to be very clear, I'm not saying that I'm like anything, like I'm not trying to compare myself with them.
It's okay.
But just in this context, right? Maybe I would be somewhere between somewhere in the middle, so somewhere like Chuck Acre actually.
Okay, you know what? That's quite uncanny, because that's exactly where I put myself also. Yeah.
I guess that's why we talk about investing quite a bit together.
Yeah, so for the viewers, if you guys don't know, this guy he's really my mentor, really no joke. I spam him every day on WhatsApp, right? Serjing, correct? Almost every day. He also spam me.
It's not spam. It's good. It's having good conversation.
Yeah, but I want to tell you guys, there's also, but me and Serjing, so just full transparency, what happens between these two investors that are discussing, right, under the wraps, behind the scenes, right? I can tell you guys, we are you see, it's uncanny. We are both Chuck Acre around the area, a bit to the left of Peter Lynch, which means that we are kind of growth at reasonable price, but a bit more towards the venture growth side, right? If I could roughly point it out. Yeah, I'm exactly like that. Yeah. And the viewers might think, oh, then like that means echo chamber lah, right? Then every time they talk about idea, then they will just agree lah. It's like just like circle jerking lah. Some people say circle jerking lah. Yeah, so I put it very bluntly. Okay, but I can tell you guys that me and Serjing, right, we are very conscious about that. Am I correct to say that? We challenge each other.
Yes.
We really challenge each other. Like later you all will see. I have some questions. You all will see. We will be clashing on. Later you see. Okay. So okay. Anyway, so you'll be at chart agree. Yeah, I'm actually also there lah. Really interesting. I wanna show the viewers, right. I actually prepared this slide lah. How I became an investor, right, and what I actually learned from Serjing. Now Serjing, I put you on the spotlight lah. Okay. For the viewers who want to know how Contraturtle learned investing, right. These are the things I actually learned from Serjing. So actually, this is the first time Serjing you're seeing this very granularly and very explicitly. How I actually got the idea of Mercado Libre, right, was actually from Serjing. When we first started discussing about this company, right, I was super hesitant. Serjing was telling me, hey, this company is like Amazon of Latin America. They've got an amazing management. Then my first response to Serjing was, it's damn dangerous. Like, like Latin America is hyperinflation, political chaos, like damn jialat. And Serjing, I don't know if you know, there was one response you said to me. I can't remember, was it over copy or whether it was on WhatsApp, but you said this phrase, in spite of. You said, yes, in spite of all the uncertainties in Latin America, Mercado Libre has continued to eke out fantastic growth, revenues, earnings, free cash flows. They've grown all their optionalities into Mercado Pago, which is their sort of PayPal and etc. Actually, this phrase, right, when you said it, right, that same night I remember very clearly, right, it was resonating inside me. I was like, I never thought to think about an investment from that in spite of kind of framework. And one thing led into another, just to let everyone know how when you get a seed of a investing framework, how it actually influences you is that after I learned about that, it made me look at the entire American market. So I'll share with you guys. A lot of people coming to me, right, on the channel are telling me, USD is gonna fall. They have all this. This one is from Mr. Lu, 1M65. Can you see all from 1970 to 2022, right? Look at how many crises has fallen upon the US market. And that's when it struck me that your framework of, in spite of all these things, the US market still prevailed. Now, there's many reasons about this. I think maybe later, if we have time, I'll talk about this. I actually met Mr. Lu from 1M65 recently, and we had a very long chat about why the US market continues to prevail long term. Let me just put it this way. I just want to give the audience a phrase to think about. I am invested in the second worst market in the world, which is the US. Winston Churchill used to have this saying that something along the lines of democracy is the worst kind of political control. Do you know what's the quote?
I think I think it's like democracy is the worst kind of worst form of governance, but we haven't found anything better.
Exactly.
Something like that.
Exactly. I hope the audience understand how all of this is connected. The US market is probably the worst market to invest in. 4 out of 5 of my positions are in the US. But in spite of that, in spite of all the problems that we've seen since the 1970s, and in spite of all the, look at this currency stuff, right? If you really look at the big picture, in spite of all this, it still prevailed. So that's why I'm still very much invested in US businesses, and also based on my own experience at work. But anyway, I digress a bit. So that was point number 1. I just want to let you know, Serjing, that's the one thing that I learned from you. Right?
Thank you.
And it also sprung into me going to Exxon. And why? Because do you remember last year I insisted you watch a video of Rick Smith's earnings transcript?
Yes.
Call, because Serjing, you don't like to watch video, I know, right?
I don't.
So Serjing, you love to read stuff, right? You don't like to watch, right?
Yeah.
Is it because of time? You prefer to be faster?
Yes. I absorb information much better while reading. So like if I were to read a transcript of a podcast and listen to the podcast, the amount of information I can absorb from reading is much higher than from listening.
Okay, that makes sense. So this is when me and Serjing, we kind of diverge, because Serjing knows that I'm a video guy. I always play him on YouTube, and his response to me is, I'll just look at the transcript.
Yep.
So we have different styles, guys. So not every investor is aligned, even though we're like Chuck Gray kind of range. Exxon was a spring off from this in spite of framework, because when I watched that earnings call, right, it was Q3 or Q2 last year, and that was right after I watched that call. I made an investment to Exxon, and it was my best investment so far by about the amount of time. I actually sold Netflix to buy that. It was the only exception. I sold Netflix. And the reason for that is because in that call, right, Rick Smith actually said, in spite of any political incumbent, whether it was Donald Trump or Biden, we are apolitical. We will continue to do well. And that was what caught me, like how you spot exceptional management. In spite of any underlying macro, political surroundings and stuff, the company will still do well. So this is point number 1. I want to tell you, I actually learned from you.
That's awesome, man.
Yeah. The second one that I learned from Serjing is that, so I read this book called 0 to 1. You saw Peter Thiel? Have you read the book?
Yep. Yeah, I have read the
Amazing
book.
book, especially for startup founders out there. You guys are watching the video. If you're starting your own tech startups or any company, please read that book. It's amazing. Peter Thiel is one of the early investors of PayPal, right? He's the PayPal mafia, right?
Yes, yes.
And also
It's part of
Facebook
the paper mafia.
and Palantir lah. This one polarizing. Maybe we'll talk about
Yes.
it later. So he used to say competition is for losers, right? And he said just go and make sure you just go and look and invest in the monopoly. But actually, the thing that I learned from you is that it's not always the case that you only invest in pure monopolies, because you taught me something about culture management, and maybe there are some companies that execute well in spite of not having a moat. And one example I can think of is Adyen. Am I correct to say that?
Yes.
Maybe you want to talk about your process into thinking about Adyen in this context.
Yeah, sure. So, Adyen is a digital payments company, and it's a very competitive space, highly fragmented market. And a lot of the incumbents in that space have built their product through kind of a very patchwork way. So they may have like a core set of code that they've written in the past, and they acquire companies, and they try to merge all these code together in a kind of like a mess of spaghetti way. But whereas Adyen has been very adamant of doing everything in-house by itself. So its entire platform is written on a single base of code, and everything is done in-house. And so what it creates is a really elegant, simple solution for for companies that want that are looking for a payments solution. And it really helps in terms of being able to drive much better conversion rates, because Adyen has all the data. Sometimes when payments companies make acquisitions, the data isn't actually the data flow isn't actually fully integrated. And so there are gaps, like there are data silos. Whereas in Adyen's case, because everything runs on a single code base, everything is written in-house, everything flows smoothly. So it's able to create a much better payment solution as compared to the incumbents and other competitors that have largely grown through acquisitions. And so I find this focus on wanting to do everything in-house, even if it's going to be slower. So they are willing to sacrifice a little bit of speed and yet retain that independence. I find that to be a quite a unique way of thinking about the world from Adyen's management team. And so I see that as a strength of the company, actually.
Got it. And this is an example of, correct me if I'm wrong, because Adyen is obviously in a very competitive market, right? Payments, there's so many,
Yep.
right? There's Stripe, there is Wise, there is PayPal, right?
Yep.
So I think this is sort of an example of, okay, Adyen may not have a dominating monopolistic moat, so to speak, but what I'm hearing you say is that they execute better and they have certain unique traits that allow them to
Yes.
compete well in a red ocean.
Yes. Yeah,
Okay.
just simply by having a better solution, and because they are so insistent on doing everything in-house, it's likely that they will continue having the better solution over time. I mean, but there is an argument to be made that perhaps over time competitors will be able to catch up to its to like the better conversion rates and the better speed that they are able to provide. But we'll see.
Okay. For the viewers who are curious, for me, I'm very kiasi one. So Adyen for me is in my not invest pile, because I really need to see some kind of mode one. But that being said, it's actually because of this execution portion, right, that actually led me into investing in Netflix. Because I remember once, now if for the viewers, you guys, if you're interested to know why I invested in Netflix, right, it's because before that I used to have a conversation with Serjing, and I asked him, they are already like streaming seems to be tapping out already, like kind of maxing out already, right? And then I said they're going to ad business and it's so competitive. There's so many players in the ad market, got YouTube and all those stuff, advertising is so competitive. So I had doubts. And I remember one day Serjing was telling me, he said that I just trust that Reed Hastings, Sarandos, and Greg Peters, these are the two CEOs, and this one is the founder, chairman. They will figure out a model that works. And when you said that, right, it dawned on me that you were putting a finger on culture and management. Am I correct to say that?
Yes.
How did this framework come about? This idea that management framework is so important, sometimes even beyond difficult markets or even beyond certain hard numbers in the short interim of a few quarters. Like, how did this come about?
Well, I think one of the formative pieces of information with regards to this is that I think in the 20 or 30 years ended like 2002 or 2003, the single best performing stock in the US market, can you guess I'll let you guess the company. Like, not the company, just guess the industry.
You mean, was this in the US or what?
In the US.
Best performing industry, best performing company.
Best performing stock.
Best performing
And
stock.
which industry did this company belong to?
After what, 2002?
In the 20 or 30 years ended 2002 or 2003.
Can't be tech, right? Could it be, I don't know, retail or something?
So, airlines.
Isn't that the worst business that Buffett said?
Precisely. So it's the exact point. So it was in that around that point in time where Buffett was so adamant that he would that airlines are a horrible business to invest in. But the single best performing stock in that time frame was Southwest Airlines.
Oh wow, okay.
And Southwest Airlines has this really iconoclastic founder and leader called Herb Kelleher. So that got me thinking. That example really got me thinking as to what is the most important thing? Is it the management team or is it the or is it the characteristics of the business? And because of this example of Southwest Airlines, I came to the conclusion that it's actually the management team that is the most important. And in fact, the way I look at competitive advantages or moats is that so if you look at any company that you think has a moat today, it was actually all the work that that management team had done in the past that led up to the competitive advantage today. And it's the management team's work today that will then determine if this competitive advantage will last in the future or if it will decline in the future. So, like, the competitive advantage is not set in stone. It is the result of management's past actions, and the future competitive advantage will be the results of management's actions today.
What you're saying here, if I summarize it for the viewers, is that in spite of Warren Buffett saying that the airline business is a terrible business to invest in, right? Like for myself, I never invest in something like SIA obviously, because like so expensive, then macro, then oil, and so such a high capex industry, right? But yet, I think what Serjing is saying is that the power of management comes through even in such a difficult industry as the best performing stock. What was it, ending 2002 for 30 years?
Yeah, the best performing stock over a 20 or 30 year period ending 2002 or 2003.
Okay. And for the viewers, if you guys are curious, the reason why I invested in Exxon was actually because of this thing that Serjing. So Serjing is not invested in Exxon. Maybe he's studying it because I always try to influence him. But the reason why I invested in Exxon is obviously because they have a very multi-product with the tasers and the ecosystem. But what really struck me was that earnings call that I shared with Serjing, where I don't know if you guys have time, please go and look at Exxon's Q2 or Q3 earnings call and look at how Rick Smith answers the questions, and you'll be amazed. Because I work in tech, right? And I discovered their modus operandi is that this CEO, right, he goes out to the field, he goes to the police station and stuff, and he interviews the officers and he finds the pain points on the ground. So he's always on the avant-garde leading edge, and then he brings the feedback to his CTO, and then the CTO carry on doing all the stuff and execute. Then he carry on going out to the field and finding new stuff again. I've never seen a CEO like that before in technology. I don't know if you've seen this before. So that was actually the management part you taught me that I start to notice about these companies. So the last one, just so because we are taking a bit too long here on learnings I learned from Serjing, is marrying anecdotes with data, right? So I noticed, so we have another common friend, mutual friend called Eugene, and I noticed that Eugene loves data, right? Maybe Eugene will watch this video. He loves data. You look at his Twitter, right? It's all the tables and
Eugene
charts.
is awesome.
He's yeah, and so I've always been an anecdotal guy, scuttlebutt, ever since Philip Fisher, Common Stocks. I read the book, right? I go down to the showroom and I talk to employers, everything. But it's because of Serjing and Eugene, right, that I start to look at hard data and charts and marry it together with the anecdotal scuttlebutt that I do. And one example is that, like how audience, you guys always see, people always say, hey, the interest rate, Jerome Powell gonna cut rates, the market gonna rise already, right? There's always this common perception, right? So I want to show you guys something, okay? And Serjing wrote a blog. You guys, I recommend you guys go and visit his blog. I'll do some plugging for you. Thegoodinvestors.sg. This is a table of the interest rates historical. Maybe Serjing, you talk about this. I'll let you talk about this. Maybe.
Oh, sure.
Yeah.
So, if I remember correctly, this is a table of so I think it was this article about like how cuts in interest rates will affect stocks. So I think the idea is that oftentimes people think that if you cut interest rates, stocks will do well. But as this table shows, like for example, look at October 1973, that was when there was a cut in interest rates. Stocks actually fell by 36%. Yeah, in over the next 12 months after the cut. So it's this idea that sometimes we can hear things that sound very logical, but they may not necessarily be reflected in reality.
Yeah.
In terms of how the financial asset prices move. So I think the movements of stock prices and interest rates is just one of these really good examples of how reality doesn't really reflect what theory says.
Yeah, so I just want to bring this back to the point about, guys, whenever we're doing investing, we have a gut feeling, right? We talk to people, we think, oh, this product and this brand very nice. But it's really important to look at the broader data. And then you realize, maybe you marry with what you see is really buigam, right? So what Serjing just gave the example is, if you guys look at October 1973, and there are many examples in this table, look at all the yeses here on this side of the column, right? All these yeses is saying, right, after the Federal Reserve cut the interest rates, right, there was still a recession after that. So, but shouldn't it be the case that you cut interest rate, then the market will rise? You see, apparently it's wrong. So our gut feeling, sometimes you have to really double check with data. There's a saying, people say that what, plural of anecdote is not data. Have you ever heard of this saying?
Yes, it's one of my favorite sayings.
Oh really? Who said that?
I don't know.
Okay, I googled that and it came out, and I think GPT gave me this, but it was a real quote. Yeah, so anyway, next I want to ask you about, some people might be interested in the tools you use, or like how you research, or what resources you read. Maybe are you able to share some of that?
I think this ChatGPT or AI chatbots is one of the, like, I guess, technological tools that have really captured people's attention. And it's something that I have started to use as well in my investment research process. So maybe I can just share what I've been doing with it.
Okay.
So I was one of the corners of the US stock market that I have had developed an interest in over the past 1 or 2 years is this thing called thrift conversions. So I have written about it on our investment blog. So for those interested in thrift conversions, you can head to the blog and read about it. But the idea is that I was doing research on a thrift a few months ago and written some notes. And then I chanced upon another thrift that I thought may have similar characteristics. So what I did was I wrote a prompt to ChatGPT Deep Research, and I said, I gave it some background, and I shared the research that I did previously on the thrift, and I told it to create a report for me on this new thrift that is similar in structure and similar in terms of the data that I want for the new thrift. And so what came out was this. Yeah, so it came out with this report on this bank that I was this thrift or bank that I was this new one that I was looking at. And so I'm able to very quickly determine if I want to pursue the idea further. And so what I realized was that this thrift did not really have the characteristics that I'm looking out for. So whenever I use ChatGPT, I'm always wary that there may be some hallucination. So I'm definitely not taking it to be the final word. But what I've found is that I think it's quite useful as a kind of a first pass for like the important things that I want to look out for. And if anything is interesting that's flagged out, then I would take a closer look.
Got it.
Do you want me to go through more examples?
You mean with deep research or?
Yeah.
Yeah, sure. Maybe you can just show us one more example. What you looked at.
Yeah, sure. So one that is, I think, really quite interesting. Okay, so I was recently looking at this potential special situations company. So it's a London listed company called Pantera Resources that is currently in a legal dispute with the Indian government over a gold mine project in the country of India. And so I got deep research to create a report for me on the entire case, as to the history of the case and so on. And so that helped me to kind of bring me up to speed about what was going on with the arbitration, right? And then after the report was created about like the cost, the details on the court case and so on, I had further conversations with ChatGPT about like follow-ups. So it was basically me having a lot of back and forth with ChatGPT about like, so I would have asked a question, it would create a report, I would read the report, I would then follow up with questions and so on. So then like ended up creating this 60-page document about the history of Pantera Resources legal dispute with the Indian government, and also quite a rich history of countries that have entered, or rather companies that have sued countries, and what were the outcomes. So it's quite an interesting, I guess, look at legal history from this from my excursion into ChatGPT.
Got it. And so if I summarize it, you use deep research in GPT, you generate a report, and then you talk to GPT about parts of the report, and you have a conversation with GPT to understand it better. Is that what's your process?
Yes, that's right. That's right. So I'll read the report. If I have further questions, then I will just so I kind of view it as like a really smart intern or employee, right?
Okay.
And then just try to have conversations with it.
Okay. Are there other tools apart from GPT you use for your research process in finding new stocks, or like to analyze companies?
No, not really. Actually, it's just the very old-fashioned going to investor relations websites and downloading documents.
Got it. Okay. Also, really, just this tool alone right now is your primary tooling lah to find and research stocks.
Yeah, just the primary filings and ChatGPT, which I use ChatGPT pretty sparingly, not all the time.
Okay.
Yeah, I mean, I have like subscriptions to like data, what do you call it, data websites and stuff, but these are not the very important part of my research process.
Okay. And like what is a typical reading for you? Like what are your resources? What do you read to keep yourself updated or to learn stuff?
So there are a few subscriptions that I think that I like. One of them will be Stratechery, which I think you also read quite regularly.
Yeah, that's like my main read for technology.
Your main read, yeah.
Yes.
That I find that really good.
Yeah.
There's one called The Transcript, which I really love. It's a weekly newsletter, and each week's edition contains this a whole list of quotes from management teams of companies on various topics.
Yeah.
And so what I like is that because there are so many listed companies, and so what the transcript has done is it's able to give me a quick overview of like what company leaders are talking about, because sometimes it's good to have to look at what other leaders are talking about, as opposed to just looking at the companies that I'm interested in following.
Yeah.
So it gives me a very wide view of what's going on in the minds of company executives. So I really like that. Yeah. So these are the two. And Mostly Borrowed Ideas. I really like his subscription service. It's a excellent deep dive into companies. Other than that,
and Twitter, right? Twitter as well.
Sorry?
Twitter.
Yes, but I find that the signal to noise ratio has worsened quite considerably with Twitter in the past 1 or 2 months. I'm not sure if you noticed that.
I've been very busy. I'm only waiting for you to send me Twitter, then I go and read.
Right. Okay. Yeah. So yeah. I mean, I still lurk on Twitter a lot. But like I said, I find that the signal to noise ratio has worsened quite considerably in the past 1 or 2 months.
Okay, I want to challenge you a bit about the transcript. Your resource. Sure. I also love to look at management as a factor. I like to read management transcript, earnings call, look at their interviews. But is there a chance that sometimes management you feel like is talking their book and making things look better than they should? Because obviously no management will admit that they are wrong most of the time lah, right? How do you reconcile with this, that management sometimes they are telling lies or making things look better than they should be.
Oh yeah, for sure. There's always the chance that you get a really smooth talking person who's not walking the talk, so to speak. The way that I try to resolve this problem is to look at the business numbers and the business performance and compare it to what the management team has said. So it's not just looking at what the management team has said. It's also looking at what the management team has done.
What are there any examples that what do you look at what they do? Like, is it financials or?
Well, I don't have examples that I can recall off the top of my head, but yeah. So I mean, like for example, if the management team says, "Oh, we have had a really great quarter with winning new subscribers to our service," for example, and you look at the subscriber growth and it's like 1% year on year or 1% sequentially. So you'll be like, is this 1% growth really quote unquote great?
Got it. Okay,
Yes.
now we're gonna turn up the heat a little bit more. So we're talking about management and promises and how good they are. So you should know that I'm always a little bit on the fence with Elon Musk with Tesla. So tell me about that. Like, this guy has not been keeping a lot of his promises, and like what's your take on that?
Yeah. So I think with Elon, there are a few things. So the first is I really like this framework for looking at people that I came across from Morgan Housel, one of my favorite writers in finance. Oh yeah, actually I should add that Morgan Housel writes for the blog of the Collaborative Fund. That's also one of my go-to reads. Just came across, just kind of floated out the top of my head now.
Okay.
But yeah, so Morgan Housel, he has this idea of looking at people, which is that you cannot expect people who are trying to change the world to have normal viewpoints. So people who are trying to change the world often have very different and unique ways of looking at the world. And sometimes you may like this different or unique way of looking at the world. Sometimes you might really hate it. But the idea is that you cannot get the genius without the crazy. It comes as a package.
Okay.
And I find that I think this applies really well to Elon Musk. You cannot get his genius without his crazy. Because somebody who's trying to make humanity an interplanetary species, I would say it's borderline irrational to expect somebody with that kind of ambition to be thinking about the world in ways that most people would think. And so I think it's just par for the course that he would have viewpoints that are out of whack, but sometimes in good ways, sometimes in horrendous ways. And so far, in my point of view, he has been out of whack in good ways, more so than in the bad ways.
Got it. But how do you?
And then
yeah.
So and then the other thing about him is that a lot of so you mentioned I think you mentioned briefly something about like him breaking a lot of promises in his business career. Is that right?
Yeah.
So I think on that, I think it's also important to realize that a lot of the products or whatever it is that he's trying to build, they are things that have not been done before. And in such situations, like for example, right now Tesla is working on the Optimus, which is this humanoid robot.
Yep.
And Tesla had to build the entire supply chain of Optimus from scratch because they realized that there were no suppliers that could give them the parts that they wanted to build a robot that was up to their standards.
Okay.
And when you have to build an entire new supply chain from scratch, I think it's just very easy to run into what they call the golden screw. Are you familiar with the golden screw problem?
No, what's that?
Also, it's this idea that like let's say you are building a car, for example, right? And then like there's just this one particular screw that has to go into the car. Otherwise, the entire thing will not be able to function.
Okay.
It may be a very low value item, but it's just that one thing. And if that thing does not come in time, like your car cannot function, right? And so they call it the golden screw.
Okay.
So it's just like you may have an entire process that in your manufacturing, but there could be like just that one part, a tiny part that is not able to come in time, or like there are problems with that part and the entire manufacturing process breaks down.
Yep.
So when you are building an entirely new supply chain, I think it's just very easy to run into these golden screw problems often. Right. So Tesla was basically one of the creators of the electric vehicle industry. Right. It's just trying to come up with autonomous vehicles that are fully powered by AI. To digress a little bit, Alphabet has this has Waymo,
Yep.
right, which is already running autonomous vehicles as a commercial product. But with Waymo, it's not fully powered by AI. Its software actually has elements of hard coding inside, and so Waymo's roll out in cities. So every time Waymo gets rolled out in a new city, changes to the code would have to be made. Whereas in Tesla's case, if it's fully powered by AI, if it works, there will not be any hard coding required, even if it's rolled out in new cities. So the idea is that the software is able to learn and operate by itself autonomously entirely. So this is something that hasn't really been done before, right? This in terms of this fully AI powered self-driving solution. So a lot of the things that Elon Musk is trying to build, and of course also you have this what do you call it, reusable rockets, right, with SpaceX. So a lot of things that he's trying to build have not been done before, right? So there is literally there's nobody that's there to be able to guide his companies as to like the mistakes to not make. Right. So I think it's just from that perspective, I think it's understandable that you have multiple promises that are unable to keep.
Okay.
Right. Saying that from the so you might say that, oh, you know, I will have this entirely new vehicle that will be out in say 2 years. But because you run into multiple golden screw problems, that 2 years can become 5 years. But I would say that because you're trying to create something that hasn't been done before, the chances of delays is actually much higher.
Yeah, I mean for me, because I'm very kiasi one so like I like to see the revenues have a stable base and then optionality on top. So ideally I want to see like for example, this is their revenues, which obviously is the majority is the EV car sales, right, at the moment. How do you reconcile the fact that like the revenues have been falling quarter after quarter with the fact that these are future things that may or may not happen? Like, how do you manage that risk in your portfolio?
So with every company that we invest in, we invest going in with the idea that we might be wrong. And so we are very aware that we might be wrong about Tesla. So how we manage that is we do it via diversification. We try to build a portfolio with multiple companies, so that even if one or two like ideas go really wrong, it will not badly affect the entire portfolio. That's how we manage the risk that of us being wrong about any certain company.
Got it. So am I correct to say actually you're a bit more VC style-ish kind of right, amongst your portfolio, the way you manage?
Yeah, I guess that's why I'm on that Chuck Acri spectrum, right?
Okay, then maybe I'm not so to that side Maybe I'm a bit closer to Peter Lynch in the middle. So maybe it's a bit of a correction Maybe I'm more somewhere in the middle Cause the viewers know I only have 5 positions. You have the fund that you run has how many positions now, roughly?
Slightly over 40.
Slightly over 40. Okay, so yeah, we have very different styles, even though we have quite similar philosophies so yeah, maybe I'm more here in the middle, and then you are a bit more to the VC. So what I'm hearing you say is that you understand that with companies like Tesla, yes, their revenues are dropping, but there is this brilliance about the CEO, which is Elon Musk. He's someone who is doing stuff that has never been done before. He's able to take up problems that involve golden screws, like what you said, right? And you feel like that's enough of a risk to put a little bit of seed money into that as part of your portfolio, and you mitigate that risk by having a wide spread of about 40 something positions that you've chosen.
Yeah, so and I guess to clarify a little, so when we first invested in Tesla, it was actually growing revenues quite rapidly.
Okay.
And driven by growing deliveries of vehicles. So it's only in more recent quarters where you kind of really see the delivery numbers decline. And that's also partly because Tesla is in the process of relaunching its, I think, believe it's Model Y.
Okay.
Yeah. So we'll see when the new version is fully rolled out, if consumer demand is still there.
Got it. And like, what's your take on BYD? Like, are you not worried that they have such a low cost basis of supply chain and manufacturing in China, and they have the backing of the government and all that stuff? Like, how do you see that clashing with on the EV front with Tesla?
BYD is definitely a formidable competitor. But I guess there have been a analog, not necessarily direct, not necessarily 100% aligned, but there's been a historical analog with like an American company with a product that Chinese companies have been trying to compete with at a lower cost, and that would be like the smartphone market, right? You have Apple competing with people like Huawei, Xiaomi, and so on. And Apple has still managed to succeed. So I think it remains to be seen if BYD will end up entirely eating away all of Tesla's market share. I doubt that would happen.
Okay, got it. And on this topic of so you run this fund called the Compounder Fund, for the viewers who don't know. But okay, I'm gonna turn up the heat quite a bit. So one of the viewers in my previous channel, I don't know how he know, this guy very smart. He knew that I was going to invite you one day, and here we are. And he says, Turtle, I'm glad to have someone, blah blah blah. I have the following question. I'll make a guess that Serjing or Jeremy from Compounder Fund. Yes, you're absolutely correct. Here it is. I've been following them since the Molifu days. Wow, okay. Though you guys are friends, I'm hoping you ask them the hard question. Yes, I'm here to ask my friend a hard question, transparently for everybody, okay? Why has the fund performed so poorly since inception? Can you shed a bit of light about this?
So one of the things that we track for the fund is the average growth rate in revenue for the fund, and also the average free cash flow margin for the holdings in the fund. For us, we think that these two metrics will be able to kind of give us a good general idea of the health of the fund, because they track the underlying business performances. So for some perspective, based on the numbers as of the end of 2024, the underlying companies in the fund's portfolio have actually grown their revenues at an annualized rate of about 23% since 2020, right? And the free cash flow has actually grown even faster at 35%. So the underlying businesses are performing really well. But unfortunately, their share prices haven't. And so, as a whole, the fund's results have actually been very poor since our launch. We have a slight positive gain, but we are badly trailing the S&P 500. We use that as one of the gauges of trying to compare our performance with a kind of like a broad basket of stocks. So we chose the S&P 500 as a kind of good comparison, because we invest heavily in the US. So we are badly trailing the S&P 500, and we only have a small kind of positive gain since the launch of the fund in July 2020. So it's nearly 5 years now. But when we look at the underlying growth of the businesses in the fund, that gives us confidence that eventually, in the fullness of time, we think that a healthy result will likely be the end outcome. And we say this because it comes back down to the core foundation of the way I think about investing, which I mentioned near the very start of this session, which is that if a stock's underlying business does well over time, the stock price will follow too. Right? It just so happened that currently there is now this there's this very big discrepancy, and I think eventually over time this gap between the underlying business performance of the companies in the fund and their stock prices would close. So the past 2 years have seen that gap narrow, and hopefully it will continue to narrow over time. And so I have some confidence. Rather, I would say that I have confidence that this gap will eventually narrow, because it's actually quite common to see even some of the best performing stocks over time in history to have their stock prices and their underlying business performances diverge wildly over time. And I think one of the really interesting examples, right, is actually this company called Teledyne. Are you familiar with it?
No, what's that?
So Teledyne is one of the companies that was profiled in this book called The Outsiders. Have you heard of The Outsiders?
Oh no, I haven't read that. Sounds familiar though.
Yeah, so it's a book about I think it was 8 iconoclastic CEOs that have delivered really strong long-term gains in the stock market. So these are CEOs of companies that have very strong stock price performances for their companies. And one of them that was discussed in the book is Teledyne. So the book is written by Will Thorndike. And it also, I believe the book also might have Buffett's recommendation on it. Don't quote me on that, I can't remember. But
Okay.
But anyway, so Teledyne was one of the companies profiled in the book, and it had a really strong multi-decade CAGR, a really strong double-digit CAGR over multi-decades. And Teledyne's founder, his name is Henry Singleton, and both Warren Buffett and Charlie Munger have publicly praised Singleton as one of, if not the best, corporate manager that America has seen. So they describe him as like a business genius. But what was really interesting with Teledyne that I've not really seen discussed, right? And actually, this also kind of I would say it's a really good history for investors to look at, because I think it sometimes, when we invest in a stock, we have this idea that it's going to be a smooth ride up if the underlying business does well, but actually it's not. It's often not the case. And Teledyne, I think, is a really great example, because it's often brought up in investing circles as like one of the exemplars of like a company that is really well run over the long term and has delivered tremendous shareholder returns. But from 1967 to 1974, Teledyne's stock price actually declined by about 80%. So that's over 80% decline over a 7-year period. And in that same period, the S&P 500 actually fell by only about 11%. But the interesting thing is, right, if you had bought Teledyne in 1967, so just before it started falling, you would have had an annualized return of about 12% by 1990. So that was the year when Teledyne was acquired by another company, right? And if you compare Teledyne's return from 1967 to 1990, that's about 12% annualized return. The S&P 500 was about 10%. So you have had that. You would have, if somebody investing in Teledyne in 1967 would, for the first 7 years, be sitting on a complete loser. But over a sufficiently long period of time, driven by the underlying growth of the business, the investor would have generated a significant market-beating return. And this example is actually not something that is isolated. It actually happens quite a bit throughout history. If you look at some of the best winners in the market, and so like understanding examples like these give us comfort that eventually the gap between the underlying performance of our holdings, the gap between the stock prices of our underlying holdings and their business performances would eventually converge.
So am I actually correct to say that actually that's actually what happened to Netflix when you first bought it at $16 and $25, right? In fact, that pretty much collapsed by more than 50% at one point when you first bought it somewhere around here, right? Like 2011-ish.
Yes, that's right.
All right. So $25 to $6. That's about.
You mean the low point at which it fell to?
Yeah.
Yeah. So I think it was $7 or $8.
$25 to $7. That's like more than 60%, right, of a drop.
Yeah. I if I remember the math, it was like about 70% decline from the first purchase.
Yeah. So I mean, not trying to defend Serjing or anything, but I know that a lot of people on the channel, you guys have saw, wow, Contraturtle made so much money, but there's one thing that I want to point out is that I think compounder fund, you guys have been quite unlucky, if I put it that way. Just a bit of, if we look at the grand scheme of things, because when you guys started in 2020, right, that was just 2 years before the huge macro crush that happened in the 2022s. That sent a lot of companies crashing down. And because I'm assuming that you have a lot of growth stocks, you kind of whack quite a fair bit. So actually, like less than 2 years into the journey, you guys got whacked really big time. I think that's why that sort of eaten into your performance over the last 4-5 years. And if like the viewers look at my pod, I only started in late 2021. So it means right, if the I'm just gonna be very harsh on myself lah. Okay, if I had invested around the same time as you guys, I would have done the same philosophy. My portfolio will not be performing like that. I'm performing at 23% CAGR right now, 24. So I think some of it is really luck. But I really believe that some of the things you say long term, the businesses, because the cash flows and the earnings that you have in your businesses, eventually the stock price will catch up, and I think it's just a matter of time. So yeah, thanks for sharing about that. So this viewer will give this question brutal, but thanks for pointing it out. We want to have a balanced idea about this. So I'm conscious of time. I'm just going to close out with just one or two more questions. So what are your thoughts on the overall AI trend at the moment, like the whole cycle?
So I think it can be quite confusing. I think because on one hand you have like a company like MongoDB, which runs like which has a database product, and so it has like tens of thousands of customers. So it's able to really have a really broad view of what its customers are doing with their own usage of technologies. And so what they are saying is that it's still enterprises are still very early in terms of adoption of AI. And then on the other hand, you have like companies like OpenAI with I think the last reported number was 800 million monthly active users of ChatGPT.
Yeah, somewhere around there. Yeah.
So you have like on one hand, enterprises seem to not really embraced AI yet, and on the other hand, you have companies with like a really attractive, popular AI product. So I think it's still really too early to tell if AI would end up being a commercial success. For all of OpenAI's subscribers and users and so on, it's still it's still burning massive amounts of cash. I think its own internal projections or projections that it was giving to investors when it was doing fundraising is that it will only turn cash flow positive or profitable at about $125 billion in revenue. Mm-hmm. So that's a staggering number, right? And so I think like it's very much an open question as to whether AI AI products can become a commercial success. And you have these cloud services providers, the hyperscalers, right, that have invested tens of billions of dollars into building data centers that contain these GPUs for AI compute. And the commentary from this management team so far is that the return on investment has actually been quite healthy. But the way I see it is that so I have in my mind this idea that there are a few different risk categories for these hyperscalers. So the hyperscalers will be four companies, right? So Meta, Amazon, Alphabet, and Microsoft. From my point of view, I think Meta is likely the one that is the least at risk of making bad investments in AI, because most of its AI spend today is actually for its own internal users. It's not actually trying to serve any external customers, unlike say Amazon and Alphabet and Microsoft, who are making investments in AI hardware to rent out to third-party users. And Meta has actually already been able to generate, I would say, positive return on investment on some of its AI investments. If you look at, say, the improvements that its AI investments have made to, say, the increases in the time that people are spending on like Facebook and Instagram and WhatsApp. There's the Meta AI, the AI assistant. There are these automation features for people who want to run advertising campaigns on Facebook and Instagram. So there are services or new features that Meta has created that are already having positive benefits to its business from its AI investments. And going forward, because it's not trying to serve any third-party users, so I think the chances are lower that it would end up investing in AI hardware that to end up having no commercial value. So like if you look at say Alphabet and Amazon, I would kind of lump them together as the next category of risk, because I see them because in their cloud computing arms, they're renting out AI hardware. But as I said earlier, right, enterprises seem to still be early in the adoption of AI, and it's still an open question as to whether AI products will end up being commercial successes. So there is a risk that all the third-party users of Amazon and Alphabet's AI hardware end up actually spending on building something that would have no real commercial value in the end. And so if that's the case, then future spending from these third parties on AI hardware will likely go down significantly in the future. And so there's a risk there that Amazon and Alphabet may end up spending on hardware that would have trouble finding demand in the future. But both Amazon and Alphabet, by virtue of the types of businesses that they are in, I think that there's a high chance that they are able to be able to absorb the investments that they've made on AI hardware. Whereas in Microsoft's case, I think it's less clear as to whether or not it has the ability to absorb internally AI hardware if third-party demand ends up not being as high as management hopes it would be. So the way I see it is that you have Meta that is, among the hyperscalers at least, you have Meta that is spending on AI in the least risky way, and then followed by Amazon and Alphabet, and then you have Microsoft, which I find to be spending on AI in the most risky way. But that's it. If I would, my bet is that AI would end up being a economically powerful force. And so the investments that the hyperscalers have made would likely end up looking pretty decent, at least in the fullness of time.
Do you think there's an AI bubble?
In some ways, yes. I mean, if you look at like the stock price movement of like Coreweave, I think I don't think its stock price movement is warranted by the performance of its business. I'm not, simply because it's heavily indebted. It has severe customer concentration risk, severe supplier concentration risk. And so all the risks that I mentioned that apply to the hyperscalers, they actually apply to Coreweave even more, simply because it's in the business of building AI-only data centers. And yet its stock price has actually increased so much since its IPO. And it was, and I don't have the exact figures off the top of my head right now, but I think even at the IPO price, it was priced at a pretty high multiple of its underlying fundamentals. But on the other hand, you have like company like Nvidia, which is at if you just look at trailing numbers, it's not at egregiously high. And if you look at valuation multiples on a forward basis, it's also not that screaming expensive, right? So it's confusing.
Numbers apart from the forward projections, what do you make of Nvidia in this whole current AI cycle?
I think with Nvidia, it's a I find it to be really interesting that in the sense that you have a company where most or all of its major customers are trying to actively compete against it. So like the hyperscalers are major customers of Nvidia, or major end customers of Nvidia. They may not be direct customers, but indirectly they end up being the ones using Nvidia's GPUs. But all of them have their own internal programs for AI chips as well. And all of these hyperscalers have incentives to want to lessen their dependence on Nvidia. So you have this very interesting dynamic there, where like most of Nvidia's major customers have the incentive and also the wherewithal to create competing products as to what Nvidia is producing. So I do not know how to handicap such a situation. So that is also one reason why I'm currently standing on the sidelines with Nvidia.
Okay, so the fund is actually not invested in Nvidia at the moment?
No.
Okay,
No.
Got it. Okay, so I'm just going to wrap things up and ask you one last question. Outside of investing, okay? So just for a typical Singaporean, what is your idea of an ideal retirement, and what do you foresee yourself doing for the next 30 years or until you die?
I don't really believe in retirement. I think it's important to have something meaningful to work on at all ages. So I think even when I am in so-called retirement age, I hope that I still have something meaningful to work on. Ideally, it will be the fund and the blog.
Awesome.
Yeah. So that's I mean, when Jeremy and I launched the fund, we made it clear that we would be investing in the way that we would if we were just running our own personal money.
Yeah.
Right. And so like the idea of doing it this way was so that we could have longevity in the project, so that we will not feel burnt out in any way. So yeah, hopefully we can be doing this for the very long haul.
Awesome. Thanks, man. I think I'm actually also very aligned on that. I also don't believe in retirement. And I think some of my videos in the past have been labeled wrongly. It should be financial freedom, not retirement. Yeah, once you find something that you love to do, investing, even for myself, I think if I'm still in the right mental faculties are still working, right mind, I probably will be like you. I probably will still be investing and researching and maybe even still making videos at an old age because I like to do all this stuff.
And
But
hopefully we'll still be
yeah,
sending WhatsApp messages to each other every day.
maybe next time it's AR already with Meta Ray
With
Ban glasses.
with the glasses and so
Yeah.
on.
So anyway, thank you, Serjing, so much. I'm gonna close this call. For all of you who have watched until all the way here, it must mean that you are quite impressed with what Serjing has shared. All the transparency that we have. There's a common theme across all the videos that I released. I think Serjing really embodies a lot of these transparency values. Do check out his blog, which is the Good Investors blog. I'll put the link in the description below. And I think this is going to be the longest episode I ever released, but it'll be worth it. All right, for all of you guys, I hope you enjoy this episode and I've learned a lot from this guy who has been a huge impact on my investing journey. All right, thanks for watching, everyone. Okay, I'm going to start recording.
Thanks for having me.